Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 February-March Paper 4-2 question number 1. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. RPPLC uses investment appraisal techniques in determining whether or not to undertake specific projects. Let's take a look at our first question. We need to explain why non-financial factors are disregarded by traditional investment appraisal techniques. This is because non-financial factors are subjective. We cannot accurately determine its cash flow into the business, which makes it difficult to quantify, which is why these non-financial factors are disregarded by traditional investment appraisal techniques. Let's write it down. The non-financial factors are subjective, which makes it difficult to quantify, which is why they are disregarded by traditional investment appraisal techniques. Now, for the second part, we need to suggest 2 non-financial factors which are disregarded by traditional investment appraisal techniques. So the first one can be all the aspects relating to human resources, such as the job, motivation, culture, as well as the working environment. And the second non-financial factor will be the impact of the project on the environment itself. Let's write it down. So human resources, such as job, motivation, culture, as well as working environment. The second one will be the impact of the project on the environment. Okay. Now we have additional information. The directors of RPPLC are considering paying 100,000 in order to acquire a license. So this 100,000 will act as our initial outlay. And this would give the company the right to manufacture as well as sell a product for the next 4 years. So the duration of the project will be for 4 years. The following budgeted information is available. We have been given the units produced as well as sold for the 4 years. We have the selling price per unit as well as the variable cost per unit. Then fixed costs, excluding amortization, which is equivalent to depreciation, are expected to amount to 19,000 per annum. So this 19,000 is just the fixed cost, which only includes the cash outflow. Now we need to calculate the net cash flow expected to arise in each of the years 1 to 4. Okay. So this is quite simple. We have 1, 2, 3, and 4 years. Now, the very first thing that will act as our cash inflow is going to be revenue. And we already know the number of units produced as well as sold. We have the selling price per unit, so we can easily calculate our revenue. And this will act as our cash inflow. So the revenue for the first year will be 6,000 times 19. Since 6,000 is the number of units produced and 19 is the selling price per unit, which gives us the amount of 114,000. For the second year, our revenue will be 10,000 times 22, which is also 220,000. For the third year, the revenue will be 8,000 times 18, which results in the value of 144,000. And the revenue for the fourth year will be 4,000 times 15, which results in the value of 60,000. Now the next item for our total net cash flow will be the variable cost, and that will act as cash outflow. The variable cost for the first year will be 6,000 times 11, which results in 66,000. The variable cost for the second year will be 10,000 times 11, which results in 110,000. The variable cost for the third year will be 8,000 times 13, which results in the value of 104,000. And the variable cost for the fourth year will be 4,000 times 14, which results in the value of 56,000. Now, our next cash outflow was the fixed cost of 19,000 per annum. So that will remain the same for the 4 years. We have 19,000 for every year. Now we can easily calculate the net cash flow. This will just be revenue minus variable cost minus fixed cost, since revenue is our cash inflow and the variable cost and fixed cost will act as our cash outflows. So the net cash flow for the first year will be 114,000 minus 66,000 minus 19,000, which results in 29,000. For the second year, it will be 220,000 minus 110,000 minus 19,000, which results in 91,000. For the third year, it will be 144,000 minus 104,000 minus 19,000, which results in 21,000. And for the fourth year, that will be 60,000 minus 56,000 minus 19,000, which results in negative 15,000. Alright, that is all for the third part of this question. Let's move towards the next part. We have been given the discount factors for the 4 years at 10% as well as 15%. Now we need to calculate to 2 decimal places the internal rate of return of the purchase of the license. So in order to calculate the internal rate of return, we first need to calculate the net present value at both of these discount factors. Let's calculate it at 10%. So we have here 0, 1, 2, 3, and 4. Okay. We've already calculated the net cash flows. For year 0, our net cash flow will just be the initial outlay of 100,000. Then for the remaining 4 years, we can just copy down this amount. So that should be 29,000 for the first year, 91,000 for the second year, 21,000 for the third year, and negative 15,000 for the fourth year. Alright. Now let us first calculate the net present value at 10%. So we can write down the discount factors at 10%. For year 0, no matter the rate of our discount factor, it will always be 1. So 1, 0.909, 0.826, 0.751, and 0.683. Now we can calculate the present value at 10%. So for year 0, that will be 100,000 times 1, which again results in negative 100,000. For year 1, that will be 29,000 times 0.909, which results in 26,361. For year 2, it will be 91,000 times 0.826, which results in 75,166. For year 3, we have 21,000 times 0.751, which results in 15,771. And for year 4, that will be negative 15,000 times 0.683, which results in negative 10,245. Now we can get the net present value at 10%. And it will be the total of these 5 values. So negative 100,000 plus 26,361 plus 75,166 plus 15,771 minus 10,245, which results in the positive value of 7,053. Now we need to repeat this entire process with our 15% discount factor. So the discount factor at 15%, again for year 0, it should be 1. Then we have 0.870, 0.756, 0.658 and 0.572. Now we can get the present value at 15%. So for year 0, it will be negative 100,000 times 1, again negative 100,000. For year 1, it should be 29,000 times 0.87, which results in 25,230. For year 2, it will be 91,000 times 0.756, which results in 68,796. For year 3, it will be 21,000 multiplied by 0.658, which results in the value of 13,818. And for year 4, it will be negative 15,000 times 0.572, which results in negative 8,580. Now we can easily calculate the net present value at 15%. It'll be the total of these 5 values. So negative 100,000 plus 25,230 plus 68,796 plus 13,818 minus 8,850. It results in a negative amount of 736. Now we need to calculate the internal rate of return. So the formula for internal rate of return is we start with a low rate, then we add the difference. So that should be the high rate minus the low rate. Then we divide it by the difference between the net present values. So we start with the net present value at low rate, then subtract the net present value at high rate, and then multiply it by the net present value at low rate. Okay, now we can just input our values. We know that we are working with two different rates, 10% and 15%. So the low one among these two will be 10%. The high rate will be 15%. The low rate is 10%. Now the net present value at low rate is the net present value at 10%, positive amount of 7,053, minus net present value at high rate is net present value at 15%, which is the negative 736. Then we multiply it by 7,053 again. This will result in the internal rate of return to have the value of 14.53%. Alright, that is all for the fourth part. Let's move towards the next one. We now need to discuss whether it would be better on financial grounds for the company to stop production at the end of year 3. We need to assume that the fixed cost as well as the cost of the license would be unchanged. Calculations are not required. Okay, now let us assume that the company stops production at the end of year 3. And we were told that we need to assume the fixed cost as well as the cost of license would be unchanged. It means that even after we stop the production for the fourth year, we still have to incur the fixed cost of 19,000 in that case, right? And we can see that the net cash flow for year 4, if we continue the production, is negative 15,000. But if we do not continue the production, it means that there will be no revenue and no variable cost. So our net cash flow for the fourth year would be negative 19,000 if we stop production in the fourth year. And this would result in a lower net present value. That is why the company should not stop production at the end of year 3 based on financial grounds. Let's write it down. So if the company stops production at the end of year 3, the company would still have to bear the fixed cost of 19,000 for year 4. This would result in the net cash flow of year 4 to be negative 19,000, which is lower than current net cash flow of negative 15,000. Since this would result in a lower net present value, the company should not stop production at the end of year 3 That is all for the fifth part. Let's move towards the next one. We again have additional information. The internal rate of return arising from the purchase of the license was higher than the company's cost of capital, and so it was decided to go ahead with the purchase. So this is absolutely correct. Whenever the internal rate of return as well as the accounting rate of return is greater than the company's cost of capital, we decide to go ahead with the project. One of the directors thought that the decision was hasty and other investment appraisal techniques should also be used. We now need to advise the directors whether or not other investment appraisal techniques should also be used. We need to justify our answer, and the calculations are not required. Okay, this is of 6 marks, so we need to have at least 5 different comments. The first thing we can say is that internal rate of return considers the time value of money. The next thing we can say is that internal rate of return uses only the cash flows. It means that it disregards any non-cash expenses such as amortization in this case, which are less subjective than profitability itself. So it is basically making a comparison between how internal rate of return is more effective as compared to accounting rate of return, which also considers non-cash expenses like amortization or depreciation. So internal rate of return uses cash flows by disregarding the non-cash expense such as amortization, which are less subjective than profitability, which is used in accounting rate of return. So it's basically saying that IRR is better than ARR. The next thing we can say is that IRR considers all the cash flows of the project, unlike payback period. Payback period does not consider the entire duration of the project. So IRR considers all the cash flows of the project unlike payback period. Then the next thing you can say is that IRR gives a rate of return that can be used to make comparisons with our company's cost of capital. So internal rate of return gives a rate of return that can be used to make comparisons. The next thing we can write is that in this case, the decision was made by comparing our internal rate of return to the company's cost of capital, which is valid in cases where no other projects are being compared. If there were several projects and the company had to decide to go ahead with only one project, in such cases, the internal rate of return of different projects would be compared along with a comparison with the company's cost of capital. You can write that down as well. Since no other projects are being compared, internal rate of return should be compared to the company's cost of capital. Now, based on these factors, we need to make a final decision. So the decision is that the company should not have to use any other investment appraisal techniques because internal rate of return has advantage over all other investment appraisal techniques that could be used. And that is why the decision made by the company is valid, as the internal rate of return is higher than the company's cost of capital. Let's write it down. The company should not have to use other investment appraisal techniques as internal rate of return overcomes the shortcomings of other techniques, and the decision made by the company is valid as the internal rate of return is higher than the company's cost of capital. That is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.